Have this kind of belief, you need to know why you invested in something. That's why it's so important to understand the fundamentals of a company before investing in their stock. This reminds me of a story Peter Lynch once shared. He's a well-known investor, and back in the day, he bought shares in Kaiser Industries when they dropped significantly. The company had zero debt, making bankruptcy very unlikely. He thought to himself, how much lower can it go? But the price kept dropping to under $10. He was shocked but held on, and the stock eventually rebounded to $50. The point is, if you don't understand the company, what will you do when the stock keeps dropping? Probably sell and lose out on potential gains. This applies to index fund investors as well. A study by Fidelity actually found out that if you invested $10,000 in a simple S&P 500 index fund between the 1st of January 1980 and the 31st of December 2022, you would have $1,082,009. But if you decided to sell your investments and ended up missing the 5 best trading days, then you would only have $671,051. The crazy thing is that missing out just 50 of the best trading days brings you all the way down to $76,104. So you might think you're being smart by timing the market, but in the long run, you're probably only going to hurt your own profits. But if you believe in your stocks for the long term, there is a lot more to it than just holding firm. In 2008, I saw what the dollar stores were doing, and instead of seeing a competitor, I saw an opportunity. If they could buy things for a bargain price, then it must mean there were amazing deals available. So I went out hunting. I went on a bit of a buying spree over the next couple of years and acquired lots of different assets, including stocks and even entire businesses. I knew that I would be unable to time the exact bottom of the market, so I invested every week. This is called dollar cost averaging. Cash is really king. If you have cash, you can snap up some amazing investments during this time. That's why it's super important to keep a steady income and supercharge it with a side hustle during times like these, as the more assets you can invest in, the better you'll probably end up doing in the next phase. The bottom line here is that while some choose to panic sell and lose all their money, others choose to double down and buy the dip, which if done correctly can make you a fortune. I feel like I should also mention that some investors like to short stocks, which is basically betting that a stock will go down. It's not something I personally do. However, people like Michael Burry have been very successful with this strategy.